So we've got cash, shares and property, yeah? Which one are you going to choose? Can I help you? Do not choose cash. Why not? Well, yes, it is low risk. Your grandma was correct. Yeah, the bank is a good place to put your money, yeah. But it doesn't give you any tax advantages, and it only gives you income or capital growth, whatever you want to call the interest on your money, right? Plus, that is very low. And cash in the bank is what I call a slow track way of investing. It's very slow. What the wealthy learn to do is fast track their money. They get their money working much faster. I'm going to show you how they do it. It's a strategy you sort of already really know, but you might have not viewed it this way before. So I'm just going to sort of take the blinkers off a bit. So we're going to need to get our money moving as fast as possible, don't we? We don't want our money moving slowly. It's safe and we can get it moving faster. I'll show you how we do it. So that just leaves shares and property. Which one are you going to choose? Which one do I choose? Well, they're very, very close. They are very close. I've got property first, shares second. Bit of super, bit of cash in the bank, right? Then you can play around and then get your emu, right? There is some clear-cut reasons why I put the property just in front of the shares. And it's not necessarily for the obvious, or what you think are the obvious reasons. I'm going to show you why. I'm going to go through these 4 ingredients and show you why I would do it that way around. You can disagree and do it the other way around, that's fine, but just do something, you know, one way or the other. But this is why. Capital growth, how did they fare? Shares and property. Well, here's a graph, went over the last 19 years. Shares did quite well, 12-point-something% as an average per year. That's pretty good. Property over the same period of time, oh, done it again. How did it go? Oh, not so well. Then why the hell are you recommending property if property shows less return than shares? Well, to be quite honest with you, if I was desperately trying to push something, I could have shown you a graph that showed property miles better than shares. Or I could have shown you a graph shares miles better than property. It just depends what time frame I chose. Yeah? I'm not trying to do that here. I'm just trying to give them an equal fairness of opportunity. And to me, property from a capital growth point of view and shares are about the same. Shares perform like this. You keep them for 10 years and they'll perform. Property is erratic. Yeah? Keep it for 10 years and it will perform. Simple. Yeah? So to me, property and shares both get a tick. Income. Shares give income. I'm talking about the ASX 200, which is the top 200 companies, yes? If you invest in them, they give you dividends. Lots of shares give you dividends. But the dividends of the top 200 are called blue chip dividends, and they are fully franked, which means, obviously, if you get income every year, you've got to pay tax on it. The fully franked dividends are tax paid at company rate, which is about 30%. You might be a 38% taxpayer, about, yeah? So you pay very little tax on the income. Very good, right? Not bad. Property, where does that give me income? Yeah, you don't need me to tell you that property provides an income by a tenant paying rent. But what a lot of people do ask is, do people rent? Is there a demand out there? Is it going to stay consistent? Well, here's some stats for you. 95% of people have rented a property at some point in their life. Let's try something really risky here in Newcastle. Could you put your hand up? I'm going to ask you to put your hand up. Right? That's been risky for me as a venture here tonight. But I'm going to ask you to put your hand up if you've ever rented a property. Go on, give it a go. Oh, some of you are like, ugh. Yes, good. That's most of you, isn't it? That's about 93.8% of this room, roughly. I'm good at maths. So, some properties that get rented by all sorts of people. 30% of homes are rented now. Walk around Australia, knock on the doors. Are you buying or you're renting? About 30% will say I'm renting, but that's on the increase. And we know why that's on the increase. People are finding it harder to get into their first home, etc., etc., etc. So what that means, though, from an investor's point of view, there's an interesting stat that now people know they've got to rent. They don't want to buy a 6-month lease anymore. There's 12 months and sometimes 2 years. A mate of mine got a 3-year lease the other day because people are sick and tired of moving around. They know they're going to be renting. I don't want to keep changing house every 6 months. I want to stay there. So they lock down with it and they make the place nice, and so they're good tenants. I know you only hear stories on 60 Minutes about bad tenants. That's because good tenants don't sell advertising, do they? If you think about it, right? So if there's an ad on the telly, tonight on 60 Minutes is a really good tenant who's really happy, and so is the landlord, and there's been nothing gone wrong ever. You must watch this. It's not going to happen, is it? Yeah. So we just want to know about the one that kills sheep on the lounge room carpet. So we'll view that, won't we? Right, so capital growth, they both get a tick. Income, they both get a tick. So now they're level pegging. Tax advantages. The law says, and I'm going to squash it down, the rule says something like, if you invest into anything that is income producing, any expenses associated with that income production are tax deductible, right? Any expenses. So you're going to invest in emus, you've got to buy the chook wire and the chook food and all of that, that's tax deductible. You invest in shares, are there any tax deductions? Well, maybe a bit of account keeping fees, there might be a bit of this and a bit of that. If you've borrowed the money, the interest on the money borrowed, just the interest payment, is tax deductible, and that's about it for shares. Property, well, an investment property is exactly like the one you're living in, yeah? It has all sorts of expenses. They're exactly the same. They're the same type of house, it's just that you don't live in both of them. They have expenses. And are they tax deductible? So to answer that question, for those of you that don't know, yes they are. And just so I've done a slide here that shows you what's tax deductible. Doesn't show you every single thing, but it just recognises that yes, the rates are tax deductible, the insurances are tax deductible, the interest on the money borrowed, just the interest payment. That's why it's okay to go interest only loan, because the principal payment isn't tax deductible. If you've got any extra money, don't pay it off your investment property. Get rid of your own home first. Get rid of your card debts. Get rid of your credit cards. Get rid of all that first, because it's not tax deductible. Leave your investment as tax deductible as much as possible, right? Once you're debt free over here, you can start being debt free over here. Does that make sense? Yeah? No? Okay, management fees. Management, that goes to the real estate agent. Get a real estate agent to look after it for you. It does help, I find it. I just like buying mine, chuck them in the corner, get Ray White or somebody to look after them. You don't know, you can look after them yourself, but I just can't be bothered. Maintenance is tax deductible, but don't be daft, right? It's a tax deduction, it doesn't mean a full refund. Do not buy something that's deliberately high maintenance. Yeah? New is far better than old as far as maintenance goes. You've got builder's guarantees and things as well. You don't need a lot of maintenance. So be low maintenance about it. Don't, you know, a lick of paint is not a tax deduction. Some plants to pretty up the garden, and it might add value, but it's not a tax deduction. Okay? Now, these things all cost us money. Yeah? There are some little cherries on the cake that don't cost us any money, but they're tax deductions. And I love a freebie. So what the government will do is they will allow us to depreciate the cost of construction of the property. And I'm now going to tell you something that could be worth hundreds of thousands of dollars in tax deductions to you. Your real estate agent won't tell you, your bank manager won't tell you, your financial planner may not tell you, your tax agent definitely probably wouldn't, but I will. Way, way better than watching Family Food Fight. This could be worth a fortune to you, right? The rule is this. We can claim 2.5% a year on the cost of construction, not the whole total cost of the property, the cost of construction, yeah? For a maximum of 40 years, okay? 40 years times 2.5, 40 times 2.5 is 100. That means we can write off 100% of the building cost on that property. Once it's 40 years old, we can't carry it on. It's not that we own it for 40 years. You understand that, yeah? 40 years of the property. You can also split the building's depreciation and the fixtures and fittings. See what I've done there? The carpets, the curtains, the air conditioning, etc. can be depreciated at a faster rate if it's beneficial to you. It may not be. So we have to help you decide that. But anyway, let's go back to the 2.5% to keep life easy. You've got it, 2.5% on the cost of construction for a maximum of 40 years. Yeah, we got that? Please nod. Right.